A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
Okay, banks are going down, inflation is on the rise, and with the price of eggs, you need to take out a mortgage to buy them. The economy is all over the place no matter what the feds are saying. We're living it. So let's get into it. It's a bank. How does it fail? Well, there are 5 ways for banks to fail, and some are kind of intertwined. Insufficient capital, bad loans distributed to consumers, meaning that they're defaulting on them, liquidity problems, fraud or mismanagement, and or an economic downturn. Well, this isn't 2008, so what's going on in 2023? Well, that's simple. We are hitting some of those requirements and banks are failing. So is your money safe? And what can you do to make sure that it's safe and protected? One way of ensuring that your money is safe is by hitting the like button, and if you're not subscribed, get on it. Please and thank you. Now back to the video. COVID gave cryptocurrency a lot of exposure to banks. However, 3 banks went down in a matter of days recently. 2 large ones, Silicon Valley Bank and Silvergate Bank, and then Signature Bank. Each of these banks dealt with one of the problems that causes banks to fail, or multiple of them. The largest bank to fail, Silicon Valley Bank, had an increase of deposit holdings during COVID. This is because the tech sector had a large period of growth during this time. From here, in 2021, it purchased long-term treasury bonds to maximize its gains on these deposits. What are treasury bonds? Well, they're an investment that basically allows you to lend money to the US government. When you buy a bond, you're basically loaning the government money for a specific period of time, and in exchange, the government pays you interest on the loan. The times of these bonds can vary. Why would a bank purchase a bond? Well, with all the extra deposits, this could have meant easy extra income, seeing as how bonds are extremely safe. In addition, these are backed by the US government, meaning the likelihood of defaulting is low. What SVB didn't expect was that the current market value of these bonds would basically tank as the Federal Reserve raised interest rates, hoping to slow down or stop the inflation surge. Higher interest rates basically raised borrowing costs, and people began pulling money out to meet their needs. But with money tied up in loans to the government, SVB needed to get cash from somewhere else to pay withdrawals to those who deposited. This led to them revealing that they had sold over $21 billion worth of securities, borrowed $15 billion, and would be selling some of its treasury stock to raise $2.25 billion. Needless to say, the day after such an announcement, most who had money with SVB withdrew in fear of losing all their money. A reasonable fear. This fear within a day after was worth $42 billion. One day after that, the California Department of Financial Protection and Innovation, DFPI, seized the SVB and handed it over to the Federal Deposit Insurance Corporation, FDIC for short. Now, this is basically the FDIC, who we all know cover up to $250,000 in banks. However, around 89% of the $172 billion of deposits are greater than $250,000. Now stick with me here. The president had this to say.
I want to briefly speak about what's happening in Silicon Valley Bank and Signature Bank. Today, thanks to the quick action of my administration over the past few days, Americans can have confidence that the banking system is safe. Your deposits will be there when you need them. Small businesses across the country, the deposit accounts at these banks can breathe easier knowing they'll be able to pay their workers and pay their bills.
And with that, the FDIC got authority from the Treasury and announced jointly with other agencies that all depositors would have full access to their funds the next morning, essentially increasing that $250,000 limit. With the bank in the FDIC's hands, it is up for sale, but still operational. Now you might be thinking, let me stick my money under my mattress. It might be a little bit more safe than a bank. Well, house fire still exists, so maybe that's not the best idea. Anyway, these things seem to be like a chain reaction similar to the last bank crash, the one from 2008 that I mentioned. One bank crashes, then it's a chain of events leading to a mass crash. To help deter this, the feds created the Bank Term Funding Program, an emergency lending program providing loans of up to 1 year in length to banks, credit unions, and basically any financial institution you can deposit money to. However, they have to put down US Treasuries, agency debt, mortgage-backed securities, and other assets as collateral. The entire program is basically to give liquidity to these institutions after the collapse of SVB and essentially reduce risk. People worried about whether their money was safe or not, but because of the president, that information has now come to us. So, should anyone be worried about their money and what to do with it? To that I say no and yes. No, because the government has stepped in, and yes, because you never know what could happen. Now, this is not me fear-mongering, just an ideal I live by. Be prepared. So in being prepared, presuming things will go back to the way they were, there are relatively two things that you could do. With the FDIC only insuring accounts up to $250,000, if you have that or less, then you need not worry. Your money will be just fine. However, the second option would be to take your money and place it into a larger institution, one which would be far more difficult to collapse. Although these banks didn't have billions of dollars available in liquidity for their depositors, which led to their downfall in the first place, there are banks who billions is literally chump change to. One that comes to mind is JP Morgan Chase, which is a bank that was merged in the last bank crash and financial crisis that we had. Both JP Morgan and Chase coming together to become the bank that we now know as JP Morgan Chase. Well, thank you for watching. Do check out my last video here. It's free for you, but can help me put out more content. Once again, thank you and see you in the next video.